Welcome back to Market Dive, the show that helps you cut through the noise and get to the insights that really matter for your portfolio. Today, we're doing a deep dive into Larry Williams' 2025 market outlook. And, well, he's calling it a Clint Eastwood market.
Oh, a Clint Eastwood market.
Yeah, the good, the bad, and the ugly.
That sounds a little ominous. But I guess that's the stock market for you, right?
Mm-hmm.
Never a dull moment. I'm Nika, by the way.
And for those who haven't met me before, I'm Kian. And today we're dissecting Williams' recent YouTube presentation. He's laid out his predictions for the coming year. And you know Larry Williams is a pretty seasoned trader.
He is.
He's really well known for these kinds of annual forecasts. And what's interesting is he uses cycle analysis to figure out these trends.
Cycle analysis.
Yep. And he actually, he predicted the 2024 bull market using this method.
Oh, wow. So he's got a pretty good track record then.
Yeah. Pretty solid track record. So let's start with the good news. What does he see as the positive forces driving the market in 2025?
Well, one of the big things he points to is that he doesn't see a recession coming. At least not yet.
Okay, so no recession.
Right. He's looking at employment figures, which are generally strong, although he does say that we need to see things pick up in early 2025.
So that's something to watch.
Definitely a key indicator. Think of it like a canary in a coal mine.
Right.
If employment starts to weaken, that could be a signal that things are going south.
Mm-hmm. Okay. So early 2025 employment numbers, definitely something to keep an eye on.
For sure.
But on top of that, it sounds like businesses are doing pretty well.
Yeah, they seem to be performing well overall, which supports this idea that, the economy will keep growing. Plus, historically, the first term of a presidency tends to be good for the stock market.
It does, yeah. So we've got a few tailwinds pushing us forward, but of course, no market outlook would be complete without talking about the potential downsides.
Right.
And Williams does warn of a potential wave of what he calls profit-taking after the strong performance we saw in 2024.
Makes sense. People are going to want to cash in on those gains.
Yeah. And for our listeners who might not be familiar with that term, could you explain what profit-taking actually means?
Sure. Basically, it just means that investors who made money in 2024 might start selling off some of their stocks or investments to lock in those profits.
Okay.
And that could lead to a sell-off in early 2025, which could push prices down. And then on top of that, there's a lot of uncertainty surrounding the impact of Donald Trump's proposed tariffs.
Yeah, those tariffs are a big question mark right now.
Huge. And even Williams, with all his experience and, analysis, he admits that there's no easy answer here.
Right.
It really depends on what specific types of tariffs get implemented, which industries are targeted, and then how global markets react.
It's complicated.
Very. We're talking about a complex web of potential outcomes. And to add even more uncertainty to the mix, the Federal Reserve, their willingness to intervene and support the market is also kind of unclear right now.
Oh, so even the Fed is a wild card at this point.
Pretty much. Nobody knows for sure what they're going to do.
Okay, so a lot to keep an eye on there.
Yeah.
But before we move on to the ugly part of Williams's outlook, could you break down tariffs a little more? I think a lot of our listeners would benefit from a deeper dive into that concept. You know what exactly they are and how they work.
For sure. Williams actually uses a great example to explain tariffs. Imagine a pair of shoes made in China that costs $1.
Okay, $1 pair of shoes.
Right. But then the U.S. slaps a $9 tariff on those shoes. So suddenly for American retailers, those shoes now cost $10.
Okay, so the price goes way up.
Exactly. And now they have two choices. They can either eat that cost, absorb it, or they can find a cheaper supplier and maybe shift production somewhere else.
Okay, so that's the idea, right? It's to encourage production to move back to the U.S. American shoemakers step in, and they make those shoes for a competitive price.
Right. That's the classic economic theory behind tariffs, to protect local industries from these cheaper foreign goods and incentivize domestic production. But Williams points out there's a really crucial distinction between what he calls output tariffs and input tariffs.
Output versus input.
Right. Output tariffs are the ones we just talked about, the ones on finished goods, like our shoes. And those can be effective, in promoting domestic manufacturing.
Okay. So an output tariff targets the final product. What about an input tariff?
An input tariff is applied to components or raw materials.
I see.
So instead of taxing the finished shoe, an input tariff would tax, say, the leather or the laces used to make it.
Oh, I get it. So it targets the stuff that goes into making the shoe.
Right. And that's where things can actually backfire, because if those materials become more expensive, It raises production costs for American companies, so it can potentially make them less competitive, not more.
Oh, that's interesting. So it can have the opposite effect of what you're intending.
Exactly. And Williams warns that regardless of the type of tariff, the initial announcement often leads to short-term stock dips for the companies involved.
Really?
Yeah, even if those tariffs ultimately have a positive impact.
Huh. So even if they end up benefiting in the long run, there's still that initial hit.
It seems like there is.
Interesting. So it's definitely something to be aware of.
For sure.
Okay. So we've covered the good. A potentially growing economy, no recession in sight. We've covered the bad, the uncertainty around profit-taking and tariffs. Now let's get to the ugly part of Williams's outlook. What does he see as the biggest threats to the 2025 market?
Well, this is where things get a little concerning. Williams points to some key valuation metrics, ways of measuring whether stocks are priced fairly. And some of these metrics are flashing some warning signs.
Like what?
Specifically, he's talking about the Shiller CAPE ratio and the Dow Jones PE ratio.
Okay. And for our listeners who might not be familiar with those,
Yeah.
could you explain what those are and why they're important?
Of course. The Shiller CAPE ratio, it stands for cyclically adjusted price-to-earnings ratio.
Catchy.
It is. What it essentially does is it looks at stock prices relative to average earnings over the past 10 years, adjusted for inflation.
Okay.
So it helps smooth out those short-term fluctuations. It gives us a more long-term view of whether the market is overvalued or undervalued.
Right.
The Dow Jones PE ratio is a bit simpler.
Okay.
It compares the current price of the Dow Jones Industrial Average to the average earnings of the 30 companies in the index.
Got it. So both of these are basically trying to tell us whether stock prices are justified by the underlying earnings of companies.
Exactly. And right now, both the Shiller CAPE ratio and the Dow Jones PE ratio are at levels that suggest the market might be overvalued.
Meaning that prices are inflated and not necessarily supported by the actual performance of those companies.
That's the gist of it. And historically, when these metrics get this high, it often means limited returns or even a bear market are coming.
Uh-oh. So that's not great news for anyone hoping that the 2024 rally is just going to keep going.
No, not really.
What does this mean for the average investor? Should they be worried?
I'd say caution is definitely warranted. It might be wise to temper expectations for 2025. Williams emphasizes that there are only two ways to really resolve this overvaluation situation.
Okay.
Either corporate earnings need to increase substantially to justify those high prices, or the market needs to go through a correction, which would bring valuations back down to a more reasonable level.
So either companies need to start making a lot more money, or the market needs to kind of take a breather and adjust downwards.
Right.
Neither option sounds particularly appealing.
No, they don't. And that's why this is the ugly part of Williams's outlook. He's basically saying that the market is in a pretty precarious position right now, and there's a lot of potential for things to go wrong.
So we've covered the good, the bad, and the ugly, at least according to Larry Williams. It seems like he's painting a pretty mixed picture for 2025. Not exactly doom and gloom, but definitely not, a guaranteed bull market either.
Right. It's definitely more nuanced than that. There's potential for growth, but also some significant risks to consider. I think it aligns pretty well with what a lot of other analysts are saying, too.
Okay. So let's shift gears a bit and talk about what this all means for investors. What are the key takeaways here? What should they be thinking about as they navigate this Clint Eastwood market?
Well, one thing that really stands out is that Williams believes 2025 is going to be a trader's market.
A trader's market.
Yeah, meaning that we're going to see a lot of volatility, lots of upswings and downswings. So instead of just buying and holding like maybe a lot of people did in 2024, investors are going to need to be more nimble this year, more adaptable.
So you're saying it's more about timing the market?
In a way, yes. You know that old saying, sell the rallies and buy the dips? That's going to be especially relevant this year. It's not a time to be passive. Williams really emphasizes the importance of active portfolio management, watching those cycles he talks about, and being ready to adjust your strategy as the market changes.
Speaking of cycles, Williams is known for his cycle analysis. And he's predicting this period of volatility that could last until around 2038.
Yeah, he is.
I mean, that's a really long time, like over a decade of potential turbulence.
It is a long time.
How should investors be thinking about their long-term strategies, given that outlook?
That's the million-dollar question, isn't it? And I think it's something every investor needs to really consider carefully. If Williams is right and we're entering this kind of prolonged period of market ups and downs, the traditional buy and hold approach might need some adjusting.
So you're not saying that long-term investing is dead?
Not at all. I think long-term investing is still the way to go for most people, but it might require a slightly more, sophisticated approach, more
Mhm.
dynamic. Well, instead of just buying stocks and holding on to them no matter what, you might need to be more proactive. Diversifying your portfolio across different asset classes, maybe, actively rebalancing things, and potentially even exploring some alternative investments.
Okay, so basically don't put all your eggs in one basket and be prepared to adapt as the market changes.
Exactly. It's all about managing risk and, positioning yourself to weather those storms.
Okay. It's a lot to process. I mean, I think it's really valuable information for our listeners,
Hmm.
especially those who might be used to the, relatively calm markets we've seen in recent years.
I agree. It's definitely a wake-up call. I think Williams is really urging us to look beyond the hype and really understand what's happening, beneath the surface.
And now let's circle back to something we talked about earlier. Williams's predictions about specific stocks. He mentioned Caterpillar and IBM as potential winners in 2025.
He did.
Can you tell us a little more about that? Why is he bullish on those particular companies?
Sure. So he's optimistic about Caterpillar because he believes the company is going to benefit from increased infrastructure spending.
Which makes sense.
Right. And his cycle analysis suggests that a rally in Caterpillar stock could begin sometime around July. He even puts a 75% probability on it.
Wow, 75%. He's pretty specific. What about IBM?
He also sees potential for a rally in IBM stock, but he thinks the sweet spot there is going to be around August.
Okay.
And again, 75% probability based on his analysis.
And Caterpillar and IBM, they're very different companies.
They are.
I mean, one's a construction equipment giant. The other's, more of a technology consulting firm.
Right.
What's the common thread there? Why is Williams optimistic about both?
Well, I think if you look at it from a macro perspective, both companies are in a good position to benefit from those broader economic trends that Williams is predicting.
I see.
Caterpillar through those direct sales of equipment for those infrastructure projects, and then IBM through its involvement in technology data management and consulting services, which are all going to be needed for those large-scale projects.
Right. So it all ties back to that infrastructure spending.
Exactly. He's not just picking random companies. He's looking for companies that align with his overall economic outlook and then using that cycle analysis to pinpoint, specific buying opportunities.
So he's combining fundamental analysis with technical analysis.
Exactly. To find stocks that he thinks are going to outperform in 2025.
Interesting. Okay, so we've talked about Caterpillar. We've talked about IBM. What about Bitcoin? Did Williams make any predictions about the cryptocurrency market?
He did. And it's interesting because he takes the same cycle-based approach to Bitcoin as he does to stocks.
So he's not just dismissing it as too volatile or unpredictable.
No, he's not getting caught up in the hype or the fear-mongering. He's just looking at those historical price patterns and using his models to see what they tell him.
And what do they tell him? What does his analysis suggest about Bitcoin's future?
Well, he sees June as a key month for Bitcoin, specifically for GBTC, which is the Grayscale Bitcoin Trust.
Okay.
He's predicting a rally could start around that time, and he actually attaches an 84% probability to it.
84%.
Yep.
Wow. That's even higher than his predictions for Caterpillar and IBM. It seems like he's pretty bullish on crypto, even in this potentially volatile market.
Yes, it seems that way, and I think it highlights an important point. Even in uncertain times like these, there are still opportunities to be found. It's all about, being smart about identifying them and managing that risk.
All right. So we've covered a lot of ground in this segment. We talked about the importance of active portfolio management, the potential implications of Williams's long-term cycle analysis, and his specific predictions for Caterpillar, IBM, and even Bitcoin. What's the overall takeaway here?
I think the overarching message is that investors need to be ready for a bumpier ride in 2025. It's not going to be as smooth sailing as maybe we've become accustomed to.
Right. More like a roller coaster than a leisurely cruise.
Exactly.
Knowledge is power, though.
It is.
The more information you have, the better equipped you'll be to make good decisions.
Absolutely. And with that in mind, let's move on to the final part of our deep dive. We're going to explore a few more insights from Williams's report and really drill down into what this all means for, your personal investment strategy.
All right, so welcome back to Market Dive. We're in the home stretch now of our deep dive into Larry Williams's 2025 market outlook.
Yeah, we've covered a lot of ground from that big picture economic landscape to those potential risks and opportunities. And we even, dug into some of those specific stock predictions.
Yeah, and in this final segment, we want to hit on a few more insights from Williams' report that we thought were really important for investors to kind of wrap their heads around.
Okay, sounds good.
One thing that really stood out to me was his take on this idea that America is, cracking or in decline. All that doom and gloom you hear so much these days.
Yeah. You know that whole narrative, like, America's best days are behind it.
Right, like it's all downhill from here.
Exactly.
But Williams seems to be pushing back against that pretty hard.
He is. He's saying don't believe the hype.
Yeah, don't panic.
Right. And he points to some interesting economic data, showing that even some of the, poorest states in the U.S.,
Okay.
their average incomes actually outperform a lot of developed nations.
Wow. I didn't know that.
Yeah.
That's a good point. It's easy to get caught up in all the negativity and forget that, things aren't always as bad as they seem.
Exactly. It's a good reminder to kind of zoom out and look at the bigger picture.
Yeah, look at the fundamentals. And speaking of fundamentals, Williams really stresses the importance of understanding, those cycles we were talking about earlier.
Yeah, the cyclical nature of markets.
Right. He sees this period of, heightened volatility potentially lasting for over a decade.
Right. And if you really look at his long-term cycle analysis, it's not just, a smooth upward trajectory. It's not like you just buy in and then sit back and watch your portfolio grow steadily year after year.
No.
There are going to be those ups and downs, rallies and corrections. It's inevitable.
And I think that's a really important message for investors to understand because it means that, buy and hold might not always be the best approach.
Exactly. It's going to require more active management, more attention to risk, and, a willingness to adapt as things change.
So this Clint Eastwood market, it sounds like it's going to be a pretty wild ride.
It does, doesn't it?
But, as long as people are prepared and they have the right information, I think they can navigate it.
Oh, absolutely. I mean, knowledge is power, right?
Always.
The more you understand, the better decisions you can make.
Well said. So that's pretty much it for our deep dive into Larry Williams' 2025 market outlook.
Yeah, we covered a lot of ground.
We did. From valuation metrics and tariffs,
Cycle analysis.
even specific stock picks,
Mm.
and of course, Bitcoin. We hope you found it helpful.
Yes. And if you're interested in learning more, we definitely recommend checking out Williams's full report.
Yeah, it's got a lot more detail, specific prediction.
Lots of good stuff in there.
Yeah. And one final thought to leave you with. If Williams is right about this, extended period of volatility, how might that change your approach to investing, both short-term and long-term? It's a question worth thinking about.
It is.
Thanks for joining us. We'll see you next time on Market Dive.